2026, the biggest change in merchant payments will be the move from checkout to intent, where AI agents decide, authenticate, and execute payments across any rail instantly and invisibly.
2026, the biggest change in merchant payments will be the adoption of stablecoin and digital wallet.
By 2026, money movement is redefined by account-to-account rails going fully mainstream, reinforced by broader adoption of 𝗲𝗏 and a deliberate further push to European autonomy in the payment rails. With SEPA at its core, instant payments become the default rather than the exception today in the EU. So in the EU, SEPA Instant enables euro settlements in seconds. In the US, Fed now reaches scale and normalizes real-time treasury payouts and liquidity use cases. When it comes to the whole discussion about the digital euro, there was quite a movement this year. However, what CBDCs or digital euro promises, instant settlement, efficiency, policy control, and programmability is going to deliver, and this arrives without a new currency, without the digital euro. It's delivered through orchestration layers on top of existing rails. Cards, account-to-account, and stablecoins don't compete, they are coordinated. Network tokenization becomes foundational, not just to lift authorization rates and to reduce fraud, but to enable agentic commerce, where AI agents authenticate, decide, and execute payments. Stablecoins take on focus role in B2B and treasury, where 24/7 settlement matters, but the real shift is architectural. Payments become software-defined policy engines. Money no longer waits to clear, it settles instantly across the most efficient rail available, delivering what CBDC promised, but without deploying a CBDC.
In 2026, the biggest disruption in merchant payments will not come from banks or card networks. It will come from stablecoins and digital wallets, quietly replacing the infrastructure we all take for granted. Stablecoins and digital wallets are more than just a hype. They represent a true inflection point in merchant payments. Both the technical infrastructure and the regulatory framework have finally matured to support compliant end-to-end funds flow. Platforms like Rapyd already offer complete solutions, allowing merchants to accept payments and process payouts globally in stablecoins or fiat via a unified customer checkout experience and on the same merchant dashboard. The benefits are compelling: near-instant payments, 24/7 settlements, lower costs and bypassing the legacy rails, and of course, far better and cheaper cross-border access. For many underbanked regions, this is a transformative solution. We've been conditioned by the banks to accept the costs, delays, and having to handle blocked payments. We're entering now a new era where RFIs and block payments are something of the past. That said, stablecoins are not a silver bullet, and cards, bank transfers, and other payment rails will coexist alongside stablecoins for the foreseeable future. Success of the stablecoin adoption relies on efficient liquidity management, regulatory clarity, and mainly consumer acceptance. To make stablecoin practical for mass adoption, companies need robust compliance, reserve transparency, and seamless and compliant on and off-ramps. And here is the reality. The old payment rails are aging out, and stablecoins are not the future. They are the upgrade the history has been waiting for.